Welcome back to the Investing on the Go podcast, brought to you by FundCalibre. Today, we're discussing value investing, UK M&A activity, and our guest explains the importance of what he calls the say-do ratio when assessing a company's management teams.
Hello, and welcome to the Investing on the Go podcast. I'm James Yardley, and today I'm joined by Alex Savides, the elite-rated manager of the JOHCM UK Dynamic Fund. Alex, thank you very much for joining us today.
Hi, James. Good morning, and thank you very much for having me.
Alex, it seems like value is not dead after all. It's had a great 6 months or so. Did you ever sort of lose faith in the value style of investing? And can this strong run continue?
Did we ever lose faith? It's difficult not to when you have such major headwinds to the style. But I think the first thing to say for us on UK Dynamic is that whilst value is a sort of a slight tailwind to this fund's process, it doesn't define the process. We've always said that sort of we're more than just value. So while we pick from what you might describe a value cohort of stocks, there always has to be a little bit more going on. We're very focused on businesses. I think you know, James, that are transforming their operations, so new management, strategic change. At the point of time that we buy them, they might be perceived to be value in their sort of valuations, price to book valuation, dividend yield calculation, PE rating. To us, we're not just hopeful that there'll be a change in external perception over value as a style, and maybe a company goes from a 7 times PE to a 10 times PE, yield of 6 down to a yield of 5, or whatever. We want any change in the valuation movement to be based on what the company have done, operationally, strategically, etc., to make the wider stock market and the investor base think that it's a more worthy business. Now, that doesn't. That's easier in an environment where people are willing to embrace a different subset of companies that are deemed to be more value oriented, maybe have been around for a lot longer. And so it does help that the style comes back. Philosophically, was value investing ever likely to disappear? I don't think so. I think the laws of sort of, financial theory and sort of common sense will always prevail. A company that's trading at a discount to its net assets, where, it has a viable and vibrant future, where it can continue to earn a decent return on those assets, will always be attractive to investors. And that will never change, really. We might go through different preferential styles. I'd prefer growth or momentum. But fundamentally, the laws of common sense say that if something's overvalued, you sell it. If something's undervalued, you buy it. And it should all start there. And I think valuation will always matter. I hope it will.
And the types of companies you buy, I mean, they aren't really the exciting ones. I don't know if you agree with that, if that's fair or not, but
they excite us, James. They excite us, but maybe not the wider public. Yeah.
But you're not likely to invest in something like Tesla soon. I mean, I think instead you're more likely to invest in something like Centrica, for example. So what is it which sort of catches your eye with these companies?
Yeah, look, that's fair. You say exciting, and these companies can be exciting. But they can also be very dangerous, as you're seeing at the moment with some of the valuation movements. And again, I'm drawn to use the word valuation. It's very important that we don't get overexcited and over emotional about our asset allocation decisions that we take. It might be very alluring to buy something that's growing at X or Y, but if the valuation is expecting a growth rate of Z for a long period of time that is rational, a longer period of time than is rational, then that's a risky asset to invest in. So we are drawn to companies that have a history, have a track record, have a long set of financial reports that we can draw on to sort of gather evidence about the qualities of the company, its inherent qualities, its inherent market position, the inherent demand for the products over many cycles, many different external economic environments. And I think that that counts for a lot. I think it's understated nowadays in the way that maybe some newer investors think about how to allocate capital. So, maybe less exciting on the face of it, but in the potential for financial return, we've always thought that change stories, business transformation can generate very exciting returns. And if I sort of stay with Centrica that you mentioned as an example, here's a company that 2.5 years ago had an over-levered balance sheet, going nowhere, losing customers, on a consistent and serial basis. Regulatory intervention had damaged returns. And here we are with a new management, new strategy 2.5 years later. Balance sheet is down to sort of net cash. If you ignore the pension deficit shrinking all the time because interest rates are going up. And the way that we think about how we discount future liabilities means that the liability here and now is shrinking. They have capital to invest. The regulatory structure that was in place has collapsed and has caused a complete hollowing out of the very competitive energy supply industry that was going on out there. So Centrica, from having lost clients, has taken on 770,000 new customers last year, most through the supplier of last resort process that the regulator has in place. But, we've gone from 75-ish suppliers down to 20-ish suppliers. And it's going to be a less competitive market, in future, but more opportunity to grow their market share. There will, of course, always be a regulated discipline to make sure that these companies don't generate an excess return. But the problem was no one was making any return, let alone an excess return. And so, and look at the earnings profile of that company. It did 20p of earnings 4 or 5 years ago through a set of management poor actions, and then external circumstances. They fell to sort of 3p of earnings, really. And now, we look to next year. I was just looking at a Morgan Stanley note this morning, actually, with a 13 pence per share earnings forecast for the next 2 years in 23 and 24. The shares at 77p. It just don't bear any relation to the earnings progression. So, buying it on a very low single-digit PE, here's why I think you can make exciting financial returns from sort of business turnaround situations in less than exciting companies. And I can't think of a better current example than Centrica, but there are many in the portfolio.
Now, I know a big part of your process is looking for positive change, and one of those positive changes is often a change in management. So how do you assess a new management team when they come in? What kind of characteristics are you looking for?
That's a really good question. We get asked that question all the time by our client base. The characteristics of a turnaround do always start with the asset, the quality of the asset that we're buying. So it would be remiss of me in answering this question not to mention that a great deal of time and effort is spent on the quality of the asset, longevity of cash flows. Is it in structural decline? If not, why not? And then sort of, are there hidden assets? Are there hidden growth characteristics? And the quality of the investments that have generated a strong return for this fund over time have managed to navigate from being sort of deemed to be going backwards, maybe in structural decline, can't see a future for the company, so put a low rating on the cash flows, to through a set of management strategic changes, external changes, environment changes a little bit, but the combination of all those things to being a sort of top right, actually growing in a structural way and generating good returns in excess of cost of capital, reinvesting in the business at high or good marginal rates of return that drives a sort of ongoing growth. And if that wasn't there or valued to be there in the rating previously, that transition can be very powerful. But we are big believers in management. We're big believers in the ability of management to take good decisions. It's often bad management decisions that alert us to opportunities. So the opposite should also be true. And I think when we interview the management teams, talk to them, get to know them, we're looking for certain clues. We're looking for capital allocation discipline as an absolute first and foremost priority for us. So that maybe some historic skill sets around how they manage capital allocation, how they think about return on capital, cash flow. We try to get into the mindset. I'm drawn to a very good book that I've read historically called The Outsiders, which is all about some of the best capital allocators as CEOs in history, and what a great effect they can have on the companies that they run. We like to see management teams that act like an owner of the business, not necessarily just through actively participating in the shares and the equity of the company, but the way that they think about the business, about running the business. Acting like an owner is a core part, not taking short-term decisions, for example, taking decisions for the best of the business, for its future health and sustainability. We look for people with a strong say-do ratio. We love that term. We love the phrase. It comes from one of our CEOs at a business called Convatec. He said, look, I came into this business and the say-do ratio was very poor. We said a lot, we did nothing. And we like individuals that back up what they say, and they don't say it whether they're going to be able to achieve it. So under promises as well. Then we look for sort of simple things. Are you going to focus the business, simplify it? Are you going to manage the balance sheet more effectively, so it can be a source of optionality for growth? Are you going to think about being a more efficient version of yourself? How do you think about your go-to-market strategy, how you price, how you treat your customer base, how you think about the value that you provide to your customer base? We investigate reinvestment strategy. How will you reinvest any capital that you release from the company? We prefer organic versus big M&A. We don't mind bolt-on. It needs to be structured, thought through, planned methodically. We've had a very bad experience on big M&A. Qualitatively, we like people persons, but true leaders that you want to get out of bed in the morning and work with, and for, and that can sort of encourage you to think like that. We like ordered and structured minds, and people that demystify the investment case and just think about a clear narrative. Some of the things that you do to turn a business around they're not difficult necessarily. Easy for us to say sitting behind a spreadsheet and a screen. We don't run the businesses, but simple decisions I think are always the most effective ones, and quick, clean decisions with enough thought going into why you should be doing it. But back to the say-do ratio. Don't tie yourself up in knots. Trying to cover off every angle. Get on with it. There's a job to be done. So that gives an insight into what we're looking for. And, those that have managed the businesses in the portfolio that have done best over time exhibit all of those characteristics, James.
And what has been the best turnaround story of your career?
Well, the ones that have been best managed, funny enough, that have had very good asset bases to work with to begin with. So the one that springs to my mind first is 3i Group, which we put into the portfolio in 2009, post the financial crisis, post a rights issue, which itself was caused by the fact that they returned lots of capital to investors in 2007, late 2007, pre-financial crisis, got overexcited, management change, strategic change, rights issue. And an asset base that was trading at a material discount to NAV. It was 40%, I think, at the time, and an NAV base that was starting to stabilize and grow. And then actually we supported a further management change in 2011. A chap called Simon Borrows took the helm as CEO and has been nothing short of outstanding for that company as a capital allocator. He definitely acted like an owner. He bought in financially and continued to do so for many years, but he restructured the company, simplified it, 120 assets down to roughly 30 to 40, putting growth capital behind the assets that he and the team had a very strong and clear view would be winners, one of which was a business called Action, which has become one of the preeminent value retailers in the whole of Europe. It's been a phenomenal success story. You've got to deal with what's in front of you. And he saw a deck of cards. He didn't buy Action to begin with in 2011 when he joined. They only subsequently bought their first stake in the asset, but he knew, as the team did, that it needed more capital, and it went from sort of 3% of assets to well in excess of 15% to now I think it's sort of 40-50% of the NAV. Second, I'd say is and I might add that the cash returns from that company have meant that when we bought it at roughly £3 back in 2009, we've had all of that back through dividends, and we've had 4 times plus our money in sort of capital return, and that's a good risk to take, and has been a good return. Second, electro components, very similar. Lindsley Ruth, who's the CEO of that business, went in I think in 2015, executed a phenomenal turnaround. Everything that we said, efficiency, balance sheet management, reinvestment for growth, but in a structured way, thinking logically about how they go to market, who their customer is, what they need to do for their customer, digital first strategy, simple strategy, and the business had exhibited more control over pricing, and has gone from sort of a business that was seeing declining gross margins, declining operating margins year in and year out, and sort of flat sales growth, has gone the other way. Phenomenal sales growth globally as well. So it's been more geographically diverse and at higher margins, a more efficient, higher drop through. Gross margins have started to go back up. So, good management there again. I won't labour the sort of ideas for the future. Those are 2 from the past, but in the portfolio, and this is not an investment decision for your clients necessarily, but 3 ideas I might pick from the portfolio today that exhibit the same characteristics: Landsec in the UK property market, Pearson in the global education market, and Ricardo, which is a UK listed energy consultant. All 3 with new management teams, new strategies, and we've got reasonably high conviction that they will do good things with those companies.
And we saw a lot of M&A last year. How did that impact the fund? And do you see M&A continuing this year as well?
I might deal with the second question first. I'm not sure it will continue to the same degree. There was a very clear arbitrage available in global markets, and certainly in UK markets, that with interest rates and sort of monetary policy where it was through 2020, 2021 as a result of the pandemic, and the distresses and stresses and strains we've had from that, there were a lot of very cheap companies trading on very high earnings yields, cash flow yields. But the ability to borrow money at very low rates for long terms, and so it was only natural that you would, and it was in the UK that arbitrage was very clearer than anywhere else in global markets really. So it was only natural that you might find, coming out of the pandemic, when we realised it was less of a demand problem, more of a supply problem, that money might find its way into a certain cohort of stocks that had been harshly treated by the pandemic. How did it affect? And I don't think the same. It's the same arbitrage is not there to the same degree today, James, because interest rates are moving, long-term rates are moving. Obviously, we sit here today, it's early March, I think the 1st of March, there's lots going on in the world on a macro basis that can change things very quickly. Valuations are moving. Interest rate expectations are moving, but I don't think the same arbitrage exists today. As it all related to the fund in 2021, and coming out of 20, it was pretty remarkable, really. I mean, this is a fund that over a 12-month period, historically, a rolling 12 months, had never had more than 2 bids. We had 10, of which 9 consummated in a rolling 12-month period. It was quite extraordinary. It shows you how much value was in the portfolio at that particular point in time. It was surprising to us to some degree, but then when we looked at the valuations, we looked at the characteristics of the companies that got bid for, not so surprising at all. And it was those characteristics that were so interesting to us and linked to the buyers of those assets. These were businesses that had infrastructure-like characteristics. They had big property bases or big asset bases, manufacturing bases. They had long-term cash flows. You could look at them and say, in 10, 15, 20 years' time, that set of assets is still probably going to be generating a reasonably strong cash flow, as long as management do the right things to keep those asset bases fresh and invest in them, and though to some degree there was inflation protection amongst those asset bases as well. They were all cheap relative to their book value. They were trading at price to book discounts. And the buyers on the flip side were all long-term capital. They were very high quality private equity, I would say, that weren't thinking about the very short term, or like in the case of Urban and Civic, they were the Wellcome Trust, very long-term investors. They were infrastructure-like investors, thought processes. And I think that was really interesting. And where they were private equity investors, some of these private equity houses had sold non-real asset companies to stock markets in IPOs, tech companies or biotech companies or, go-go structural growth companies for, in the energy transition, say, at high valuations, and were recycling their capital in existing listed companies at really low valuations, and sort of more traditional companies that you might think are the less exciting. And we thought that was really interesting. So good characteristics for the fund. I think a good endorsement of what the fund does, how it tries to generate value from its investment decisions.
Were you happy with the bids you got, though? I mean, or do you feel
not in all cases. No, it's a really good point.
You had to let go of some things which you perhaps wouldn't have liked to.
It's a really good question. No, I don't think so. And, I think a lot of those bids were at discounts to what we thought were fair value. And I think it's, it's a sad state of affairs that some of the boards were willing to back those bids, and were so readily willing, in our view, to back those bids and not play a harder, more Machiavellian game with the potential acquirers to try and get better value. We had to start. So, absent the boards doing it, who is it incumbent on to do that, to protect shareholders? It's incumbent on us, the more institutional minded shareholders that take a longer term view. And we did that. We stepped up to the plate, and we would do it again. And, in the case of three companies, we were very vocal. In the case of St. Modwin, in the case of DMGT, in particular, and in both cases, we, along with others in the case of DMGT, I don't think any others in the case of St. Modwin, managed to squeeze a bit of extra value from the acquirers. But it was tough. It's tough to negotiate when you feel alone. But we do it again, and it is our job as stewards of capital to do that, and we take that job very, very seriously.
Well, that's been really interesting as always, Alex. Thank you very much for that.
That's okay. You're very welcome. Thank you.
As we've highlighted in this interview, the Jockum UK Dynamic Fund targets companies undergoing a period of change, taking advantage of this transition to deliver long-term growth returns. Having built up an excellent long-term track record, Alex's process has shown itself to be successful in numerous market conditions. To learn more about the Jockum UK Dynamic Fund, visit FundCalibre.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.